This is Daybreak Asia. We're counting down to Asia's major market opens, and what a week it's been when it comes to the yen volatility. There's a suspicion of intervention. Of course, looking at the current account numbers, we do see in some aspects some characteristics of at least two bouts of intervention by Japanese authorities in the currency this week, right, Bell? But of course, we are still looking ahead to those US jobs numbers after the Fed commentary, the less hawkish than expected pivot that we heard this week. You know, whether that's going to kind of firm up expectations for policy going forward.
Yeah, that's right. Certainly that big focus on non-farm payrolls, expecting around a 240,000 gain for the latest reading, slowest pace since November, Haidi.
Yeah, and of course, big tech is in focus today. We'll be watching some of those Apple adjacent, the suppliers and the such, as we did see really investors reacting pretty positively to what was ultimately a mixed bag in that latest set of numbers. But let's get you straight to the start of trading. We're just about 10 seconds into the start of cash trading as Australia comes online for Friday. Pretty flat at the moment, not much to report, but it has been a pretty sort of difficult few sessions for Aussie stocks. Taking a look at where the Aussie dollar is trading, 65.72. A bit more calm when it comes to FX, and certainly the yen is holding pretty steady as well. Brent crude is trading at just shy of $84. Quite a bit of pressure we could see on the energy names across Asia today as these concerns continue to weigh on the demand side for oil, looking like we're setting up for the weakest week that we've seen across oil prices since about February, as those US inventories weigh and these concerns about OPEC plus policy maintaining their stance are sort of impacting these concerns about supply and demand in the market, Bell.
Yeah, and Haidi, and also we've got to the start of trading here for Korea as we come online this morning. Japan is shut today for another public holiday, but we do see Korean equities posting some gains at the open. We're also seeing a bit of Korean won strength coming through. We did see the dollar having its weakest session overnight so far for 2024, ahead, as we were saying, that jobs number or jobs report later Friday. But certainly what's playing into the theme for Korean equities as well, or what could play into the theme, is the Apple numbers. And let's just take a look at how some of those stocks or suppliers are coming online this morning, because we've seen Apple, that jump you've got there in late trade, a gain of more than 6%. And we are just seeing some gains as well for some of the companies that, again, supply into that US big tech giant. Company posting stronger than expected sales last quarter, predicting a return to growth as well in the current period. So a bit of optimism that a slowdown is perhaps easing. But let's bring in our next guest, who remains positive on global equities with a preference for US tech. Joining us now is Kieran, Calder, head of Asia Equity Research at UBP. And Kieran, it's been sort of a mixed reporting season for big tech so far, but with what we've got, are you optimistic about the outlook from here?
Yeah, so we are optimistic on equities, and have been looking to add on any weakness related to what's going on with the current results season. You know, you mentioned Apple, and obviously less bad than feared can be a strong short-term catalyst. And obviously with one of the largest supply chains in Asia, we think this is going to be good for the whole ecosystem, probably today.
And the moves that we've seen so far in US stocks over the course of this year, given that sort of rates environment that we're expecting, where do you see the direction heading into, I guess, the second half at this point?
Yeah, so for us, we think that the second half is going to be a period of strong earnings momentum. You know, if we were sitting here 4 months ago, we would have said that would be coupled with, the beginning of rate cuts. But, we are also of the camp that this has been pushed back at least till the end of the year. If you consider that, the biggest mistake that the Fed could make would be to start to cut too early and see a resurgence of inflation. So, the latest inflation prints have obviously proven that inflation is sticky against a U.S. economy which is doing pretty well. So we think, the net effect of that is going to be pretty good earnings growth momentum in the second half of the year, and that's why we would be looking to increase allocation to equities, especially growth, and that takes us to tech, obviously, in the current period.
Kieran, would you also be looking at sort of more international allocations with the big moves that we've seen in the yen, the multiple attempts at intervention that we see most likely was what played out this week? Are you looking at opportunities within Japanese equities still?
Yeah, absolutely. So I mean, it's obviously been a interesting period. Since the BOJ finally gave up on ZIRP, the market peaked 2 days later, and now we're in this period where basically Bank of Japan has very little control over where the yen is going to go, given that the rate differential versus the U.S. Is going to persist. So it's the intervention, while it's been pretty effective in drawing a line in the sand at 160. Most likely we'll see that get tested again, and the period for the yen stop weakening is going to be when U.S. rates start to get cut and the differential changes. So against that, we're sort of in, as I said, the market peaked a couple days after the end of ZIRP. We're in the period right now of full year results, next year's guidance, and heading into the AGM season. So we think that it's become a stock picker's market in Japan after the sort of big one-time catalysts over the course of the last 18 months. And we're looking forward to seeing additional push on the corporate governance side and restructuring, et cetera, through the AGM season. So we're ready to add on weakness in Japan at the moment.
I wanted to get your thoughts on the Hong Kong rally as well. We're now starting to see signals, and in fact the first time since the sort of reopening rally, that maybe 8 shares are looking overbought. Do you think that this is sort of another false dawn when it comes to this market, or this sort of fundamental drivers for this rally to continue?
So for us, we think obviously 3 years of underperformance have left the market cheap and underowned and unloved, and you have to consider that in the context of the current rally. We still have an underweight view on China, and we think there's structural issues that still need to be addressed. On the other hand, less bad news or lack of bad news at the end of a 3-year underperformance period of underperformance can itself be a catalyst, and that's what we've seen. So our current view would be to try to take profit into that until we see real structural change, especially in the property sector, that would help, or we think is a precursor to the long-term investor confidence, especially foreign investor confidence returning to China. But of course, the strongest large global market so far this year on a U.S. dollar basis has been China H. So we're having a period right now where we would probably look to take a little bit off.
And what are your views on tensions, of course, between the US and China? Because those are set to go higher, perhaps in an election year. And you've highlighted one of the key risks of being a return of Donald Trump to the presidency. But what are the key risks that you would associate with that?
Well, anything goes with a second Trump presidency. So I think it would be something just we have to stay clear. Look, I think it's becoming, there is a real chance that, Trump comes back. Obviously, he likes to have an enemy once it's no longer Joe Biden, or if it's no longer Joe Biden and he does get back in, we would be very cautious around China, and really anything goes. On the other hand, it's pretty even if you look at the odds so far, and we're a few months away. So something to keep an eye on, but nothing concrete for now.
Kieran, always great to chat with you. Kieran Calder, Head of Asia Equity Research at UBP. We are just getting a development crossing the Bloomberg when it comes to GIP and CPP are nearing a $5 billion deal for the utility group Elite. This is a provider of energy services across the upper Midwest of the United States. They're sort of across generation, transmission and distribution of electricity power for retail and wholesale. We're hearing that the global infrastructure partners and CPP investments are close to a deal to buy Elite for about $5 billion, according to the FT. There has not been any comments so far, but we'll bring you details as we get them. Still ahead this hour, Australia's retirement program, our super funds, may be the envy of the world right now, but still face challenges. We'll be discussing calls for reform with the CEO of a leading superannuation industry body. This is Bloomberg. Take a look at one of the stocks that we're watching just about 10 minutes into the start of trading here in Sydney. Macquarie Group down by about 1.8% there after earnings missed estimates. We saw that plunge in profit from weakness across its commodities business. The global markets business was weak as well, dragging on that overall performance. Net income falling 32% to 2.31 billion US dollars, short of that 3.6 billion Aussie dollar average projection from the analysts that we surveyed. And we have seen that underperformance across the share price as well in terms of the comparison to global peers over the past year. Those expectations were pretty well flagged for a soft result. We have seen so much volatility in energy markets and that environment for M&A being pretty sluggish as well, Belle.
Yeah, Heidi, and another group of stocks we're tracking this morning are Apple suppliers here. You can see pretty much rising across the board. Unsurprising because Apple itself is also jumping in late trading after posting stronger than expected sales last quarter and predicting a return to growth for the current period. So let's get more on those numbers, bringing our Bloomberg tech reporter Mark Gurman. And Mark, what stood out to you the most from these numbers that came through?
Yeah, from the numbers, the biggest highlight was Apple did quite a bit better in China than Counterpoint Research, IDC, and others had anticipated. They had said that iPhone sales in China had declined by 19%. Tim Cook was asked to try to square that away on the earnings call. But the truth is, how could he, right? These are third-party analyst reports making one claim. Apple has the actual numbers. They don't know where the Counterpoint or the IDC numbers are coming from. Who knows if Counterpoint or IDC even know where their numbers are coming from? The reality is, China, iPhone numbers, not so hot. But Cook is saying it has nothing to do with the iPhone. It's the company's other products, and they have some work to do there. The other thing that stood out to me was the numbers on wearables, home, and accessories. That came in about 900 million below where we sat a year ago. Not so great, given the Vision Pro launched in this quarter, right? So that means in the Vision Pro's launch quarter, and of course sales are only going to go down from here during the current pricing cycle and the current product cycle for that product, not creating any growth in that category is a little concerning, but obviously we're still in the very early innings on that product.
Mark, I remember speaking to you a couple of weeks ago and you were saying that Mark, just going back to Apple in China there, because I remember speaking to you a couple of weeks ago and you said that you felt that Apple needed to make tweaks or changes to its product lineup that were specific to the Chinese market. Given the numbers that came through, do you think it alleviates that need for the company to do so?
Yeah, actually what I believe I said is they need to create some products to really create new growth opportunities in emerging markets. They're, as they explained on the call today, China's the ultimate emerging market, and they're doing quite well there. Indonesia, they're growing, right? But they have limited market share still in those regions. And I said to up that market share, to go even more quickly, they should release a cheaper phone tailored to emerging markets, bring more people into the Apple ecosystem, sign more people up for Apple accounts, and then as the middle classes in China, Indonesia, Vietnam, Eastern Europe, Africa expand over the next several years, then you can sell those consumers who are already in the Apple ecosystem those higher end products. So my theory wasn't necessarily about China in particular, but more of a global emerging markets play.
Mark, we spoke to an analyst earlier who sort of pinpointed two strengths. One is obviously the Apple universe, right? The infrastructure and the loyalty that customers have. And the other is AI. And it's interesting. Do you see enough progress being made in terms of playing catch up on AI for that to be a strong proposition for Apple and loyalty to Apple going forward?
I think the AI play is going to make the ecosystem more sticky. I think certainly when people are choosing to buy new phones and they're deciding if they're going to buy an iPhone or an Android phone, I think the AI features on the iPhone are going to perhaps make the iPhone more interesting. It's certainly going to make it more competitive in the current AI landscape. But I don't think they're going to sell a ton of new devices from the get-go because of these AI initiatives. This is something they had to do. They're placating Wall Street, they're placating consumers, and they're really starting this next generation cycle of software and proactive intelligence in these devices. And, you know, I think that this play is going to have a positive outcome for them. This is not something that's, you know, specific to the iPhone. This is something you're going to see on the iPad, you're going to see on the Mac, the Vision Pro, the Watch, etc. So certainly this is a long game for Apple, as is everything they do.
Bloomberg Technology reporter Mark Gurman there with the latest at those numbers. And let's stick with tech. And Bloomberg has noted that Huawei is secretly funding cutting-edge research at US universities through an independent foundation in Washington. That's despite a web of restrictions officials have imposed on the company over national security concerns. Our tech and national security reporter Kate O'Keefe has the details and joins us now. So in your story, what was it that you discovered that Huawei was able to do to be able to fund this research in secret?
Right. So what we learned is that Huawei partnered with a foundation based in Washington, D.C. called the Optica Foundation. And the Optica Foundation administered a research competition that attracted top researchers from all sorts of top universities in the U.S. and globally. And what we learned is that these researchers, when they were applying to get funding through the competition, they believed that the money was coming from this U.S. entity. But in fact, it was actually funded completely by Huawei. But there had been no disclosure to them about that.
No disclosure, perhaps a bit of a grey area, but is this indeed legal?
Well, that's one of the most interesting things, is that it appears to be totally legal. It's amazing because Huawei is on so many different lists in the U.S. for restrictions, including very severe export controls that prevent a lot of prevent sharing of technology with the company. But in this case, this research competition is sponsoring academic research, which is generally, meant to be published, and that's actually exempt from export controls. So there's nothing that's actually illegal with this, and that I found that to be one of the most interesting parts of the story.
What have we heard from Huawei, the Optica Foundation, and also have we heard anything in terms of the universities and the academics and researchers that are involved?
Right. So Optica has said, look, we have many donors who like to remain anonymous, including U.S. donors. And that's maybe the case, but there aren't U.S. donors on export control lists. Huawei has said that they wanted to keep their name out of it, or their name was kept out of it, because they didn't want the event to be seen as overly promotional. And then in terms of the universities and the researchers, I haven't been able to find one, relevant university official or researcher who had any idea about this until I called them.
That was our tech and national security reporter, Kate O'Keefe, who was behind that Bloomberg exclusive for us. And let's shift now to Qualcomm, because we saw shares jumping the most in 2.5 years after an upbeat forecast pointing to a rebound in demand for smartphone chips. CEO Cristiano Amon told us what's driving growth in the key Chinese market.
The story on handsets in China is pretty simple. We've seen the market had stabilized. We had said about that a couple quarters ago. And users are buying better phones. It's really, for us, a story of flagship and high tiers within the Android, especially a lot of those flagships that are launching with Gen AI. I think we see the very beginning of Gen AI coming to devices. And that actually drove, a lot of the growth. And it's 40%. Not only in this quarter, but actually expected to have the same in the next. As we look at the guide, it has been a good story as the smartphone market stabilizes, and Android flagship has stayed resilient.
Cristiano, as you know and our audience knows, we will talk about on-device when it comes to generative AI. Let's just linger a moment longer on China. It looks like some of the domestic players that are Android-based are gaining market share against Apple and the iPhone. You see that in the IDC data. You see it in the Counterpoint research data. If that is the case, where the domestic players are gaining that market share, what does it mean for Qualcomm?
Look, the way you should think about our position in China in the handset market, we have been very focused on the premium and high tier with Snapdragon. So when an Android OEM from our customers, Xiaomi, Oppo, OnePlus, Honor, Vivo, when they're selling a flagship device, we have a lot of content. Not only we have the modem content, but we have a lot of the application processor, the AI engine. So that has been a positive development, and that's what is being driving the content increase and the ASP increase, especially when the mix changes to a premium device. The fact that the Android flagship in China with the Chinese OEMs had been stable, proven to be resilient, and see positive momentum as the mix get richer. Chinese users are buying a better phone. That's a good story for Qualcomm, and it's reflected in the numbers.
Qualcomm CEO Cristiano Amon there speaking with our colleague Ed Ludlow. You can watch us live and see our past interviews on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about. You can join in on the conversation as well by sending us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. That's at TV Go. This is Bloomberg.
You're watching Daybreak Asia, the latest in geopolitics, and Hamas says it's studying a temporary plan or ceasefire plan with Israel in a positive spirit as international pressure mounts on both sides to reach a deal. The Iran-backed militant group says it plans to send a delegation to Egypt as soon as possible to continue negotiations. Israel said it would only consider joining ceasefire talks once Hamas responds to the latest proposal for a temporary truce and release of hostages. Turkey is halting all trade with Israel over what it calls the worsening humanitarian tragedy in Palestine. Israel's imports from Turkey reached $4.6 billion last year and include machinery, fuel, fresh produce and food. Israel's foreign minister used a post on X to call the ban the behaviour of a dictator. US officials say Russia and China are working more closely together on military issues, including a potential invasion of Taiwan. Director of National Intelligence Avril Haines told Congress that Beijing definitely wants Moscow to be working with it on Taiwan. She said intelligence assessments indicate increasing cooperation between Russia and China across almost every sector of society. Quick check on commodities this morning, and we're keeping an eye on what oil is doing, just tracking a little bit higher so far. We're actually, though, broadly on track for the biggest weekly decline for crude since February. So it are these concerns of weakening demand, and then as well there's increasing speculation that OPEC Plus will prolong output cuts to shore up prices. So something that could perhaps be building into that positivity a little bit this morning. Iron ore to note as well, we're just a little bit weaker so far in the session. Copper, though, holding on to some recent gains, Heidi.
Yeah, take a look at how we're opening up when it comes to futures in Europe this Friday session. Seeing quite a bit of positivity as we've seen kind of some of those early gains here in Asia really boosted by what we've seen across tech stocks rather than the reaction to Apple. So we're looking at that reversal of the previous session for Europe where we saw modest losses. Some of that pressure across drops in retail, technology. Higher for longer is still really that messaging that is playing through when it comes to European markets as well from the Fed, that is. We're seeing futures up by about 0.3% when it comes to the Stocks 50, German DAX futures to about the same tune, and sort of watching pretty much stability when it comes to trading in the euro at the moment. Here in Asia, we're seeing some upside for the likes of Australia and South Korea. Hong Kong futures looking pretty positive as we continue to see really signs that H-shares are looking like they're venturing into overbought territory. Much more to come here on Daybreak Asia. This is Bloomberg. A Bloomberg analysis of Bank of Japan current account figures suggests the government probably intervened in currency markets on Thursday for a second time this week. Let's get more from Garfield Reynolds, who leads our Markets Live Asia coverage. And Garf, I suppose, how helpful is the analysis as to when and if and how they did it? And are we still kind of looking at, triggers and thresholds as helpful guidelines as to when they might do it again?
I'm not sure. Well, OK, so the data are pretty clear that they did intervene. It looked like a duck, so to speak, on each occasion. The move was so rapid and so large. And then when you look at the BOJ accounts to show what happened with, where the money would have gone, as it were, then that's the quack. It quacked like a duck. So I think we can say this is an intervention duck, and we've seen it twice now. Putting such frivolity aside, we're now in a situation where it's not clear that thresholds matter too much, because now that they've pulled the trigger, they've decided to intervene for whatever reason. It does look like it got close to the sort of level where they should intervene based on what Calder had been saying. It was also a propitious moment when they first moved because it was a holiday, so liquidity was thin. And it was also, they were to some extent forced into it because yen trading had become so disorderly. And that's something that they would have been worried about. If we don't stop it here, never mind the level, it's going to go to the sort of levels that we really don't want to see it at. So all of that meant that it made a lot of sense. Now, they're likely to be opportunistic because once they've started the process, they want to get as much bang for the bucks that they're spending as they can. So you could easily see them come in again after jobs tonight, even if jobs is weak, because they might look at it and go, well, here's a chance to drive it down all the way, drive dollar yen rate down, that much further, and sort of really put some distance from those sort of levels, especially because, as I said, Calder had indicated that the pace of declines was what would worry them and what would bring them to intervene, and they'd got to that sort of level. But now that they have intervened, the way currency trading works, it's going to be seen as, those levels where they intervened, 160, 157, are going to be seen as really important markers. So the further away from those levels you can keep the yen in the coming weeks, the better the case is for thinking that they've put a really solid floor under the yen. Similar to what went on last time they intervened in 2022. They intervened on several occasions, even after you might have thought it wasn't that necessary, but they did, sustainably drive the yen away from the levels that it got to then. Now, they ended up having to intervene again. Why? Because the policy and rates divergence set up drove everything down against the dollar, but especially the yen. So they were facing that pressure. And in particular, they were in a situation where it looks like neither the BOJ nor the government were particularly keen to see the BOJ embark on a series of rate hikes anytime soon. But if they didn't, the yen was going to keep falling. So they don't want to recreate that situation anytime soon. And therefore, there's always the chance they'll step in again to try and give themselves more breathing room going forward.
I think they need a mascot. They need an intervention duck.
Yeah.
Yeah, intervention duck. And well, if we want to stick with the avian theme, we can talk about taking flight, because Hong Kong stocks have been really soaring this week. But Garfield, do you think that can continue?
Well, the big problem for the China case in general, and we're talking about Hong Kong gains here, we're talking about a lot of it is to do with Hong Kong traded China stocks, or even if they're local stocks, obviously China's a big part of it. They've had problems sustainably gaining altitude before because there are so many immediate factors that call out for caution with where China's economy is, and because investors have been burned so often before. So where we are now is among the more promising setups, because those valuations had got so low, also because that yen intervention and the groundwork for it, like dollar strength looking vulnerable, that's important for the yuan, which is off, at least in China's off the last 3 days of this week. So, but pressure on the yuan to depreciate has been, a big break on the potential for the PBOC to carry out easing, because if they don't want to let the yuan depreciate too much, it's really hard to ease noticeably policy terms without setting off yuan declines. That is out of the picture now, so investors are optimistic that there's a turnaround for China and Hong Kong, and also that there's potential that policy support will be greater going forward.
Alfred Reynolds, who leads our Markets Live Asia coverage here, and Australia's $2 trillion, US dollar, I should say, retirement system is proving itself the envy of the wealthy world. BlackRock CEO Larry Fink even told American policymakers to build on Australia's model to solve problems in the US social security system. But today's Bloomberg Big Take reveals most Aussie retirees still have much less than they'll need. At the end of last year, almost two-thirds of 60-year-olds only had around $130,000 US dollars in savings, even after 32 years of mandatory employer funding. Well, joining us now is Mary Delahunty, who's a CEO at the Association of Superannuation Funds of Australia. They represent corporate, industry, retail and public sector funds. Mary, really great to have you with us. And it's a really timely point to be having this conversation, given the sudden kind of global focus on the Australian model. No system is without its flaws, but is this the most sort of perfectly imperfect pension system in your view?
It is something to be incredibly proud of, I think. The nation has built something over only about 32 years that is the envy of the world for really good reason. It starts with some central principles that are to be, I think, much sort of hugged by Australians and held on to. Those principles being universality, so the coverage of the system is wide, and preservation. The money is held until retirement. And it's those two sort of central elements of our system that you can find are missing in others that haven't quite managed to get to where we've gotten to.
What are global peers asking you about the Australian system?
There's a lot of conversations at the moment, especially as you mentioned from both the UK and US colleagues, that ask us about how we've gotten to a defined contribution system that is not only increasing individuals' prosperity as they reach the end of their working life, but also increasing the nation's economic prosperity overall and taking, albeit slowly, but certainly a burden off the government public pension. So they ask us about the setup of that. They ask us about how Australians feel about that. They ask us about the politics and the ideologies and about who are the champions of this system. And in reply, we talk about some of the challenges that it still has, because it's good to see other nations being able to build a really robust system that they can, leapfrog some of the things that we've had to work through. And we talk about how, though, it is really well loved in Australia, I think, and I think people are, whilst we often talk about disengaged with superannuation, I think increasingly people know it's there, they know what it's there for, and they expect us all to do our jobs in protecting it and helping it grow. But the system itself needs to shape a little bit to a modern working life as well. And those are some of the smaller challenges that we have in front of us, even though we have this really well-celebrated and world-class system.
Yeah, Mary, you mentioned some of the challenges that the Australian superannuation system has had to sort of jump over. Can you elaborate more on those? And also, as you said, reflecting more of that modern day of working or modern life.
Well, in the central components of the system, I talked about preservation and talked about universality. One of the other things that we really need to focus on is equity as a sort of a central tenet of the system. Equity can be delivered, so equal outcomes for people, if the superannuation system and retirement income system better reflects their working life. So when it was designed, we had workforce participation that was primarily based on that sort of typical male model, where a person remains sort of attached to their employer for the duration of their working life, and then they stop work, and then they start retirement. And I think if you look around society now, that's really not reflective of the way most people interact with their workplaces and even their sort of vocations, their way they work. Especially true when you think about the people who overwhelmingly take time out of the workforce to add economically to the country in an unpaid capacity. So we might be looking after elders, might be raising other children, and in that sense, that's overwhelmingly done by women. And so that's naturally going to have worse outcomes when it comes to retirement. And in a nation such as ours, where we are prosperous and we are lucky and we have built a great system, we don't want the face of poverty in retirement to be a woman who's dedicated some of her life in an unpaid capacity to the rest of us. So that's something to work on. And then we've got this sort of concept of retirement, which we're really turning ourselves to now.
And Mary, I guess perhaps then not everyone has enough money to confidently retire on, but given the pool that people actually do take out or extract at the end, is there enough education, I guess, that's being done so people know how to spend their money wisely and really try and make it last for the longer term?
We can always do better with helping people make the most of the settings that they've got in retirement. And that comes to whether or not we can, people can access advice or help in such a way that is meaningful to them, that is cost effective. But there are a range of sort of outcomes in retirement, and superannuation wasn't ever meant to completely replace the government age pension, and it is to supplement where it's still needed. And so we've have to sort of, ease off it a little bit in terms of that it is definitely helping people's dignity as they finish their working life. We can do better at talking with them about what it is they want to do in their post-working life and how they might want to spend their money and how to make that last longer, but also what role the government age pension has in that as well.
Mary Delahunty, CEO at the Association of Superannuation Funds of Australia. They're joining us from Melbourne. We appreciate your time. And subscribers can get more on that big take on the terminal. That's NI Big Take is your function. Bloomberg.com on the website has it as well. More to come here on Daybreak Asia. This is Bloomberg. Take a look at one of the stocks that we're watching. We've seen Macquarie really essentially erase almost all of the losses of the first 45 minutes in this session. The bank did report a steep 32% decline when it comes to full year cash profit. Paul Allen is with us for a bit more analysis. So, this was pretty well flagged.
Yeah, it was, and some real conflicting factors here in terms of what we're seeing with the share price at the moment. But yeah, Macquarie said it wasn't going to be a great year, and true to their word, wasn't. Off 32%, $3.5 billion cash profit, that was a miss as well. The commodities part of the business, that saw a 47% decline in terms of its contribution to net profit. There's been substantially lower inventory management, according to Macquarie. Trading income's been down. And it's the same story for the investing arm as well, a 48% decline in net profit contribution there. And as we know, it's been a pretty weak environment for deal making, M&A and the rest of it. Macquarie did note that there's a lot of uncertainty at the moment, and we know that too. Subdued market conditions in many parts of the world. The dividend looked pretty good on the face of it, $3.85 a share, but that's a 14% decline on the year prior as well. So all in all, yeah, it was a difficult year for Macquarie.
But did it look a little bit more optimistic than what we got from the guidance, do you think?
Well, we were closely watching for the guidance, thinking, oh yeah, we're going to get a pretty good steer on what the next 12 months holds, and yeah, very light on specifics, apart from this statement. The CEO saying Macquarie remains well positioned to deliver superior performance in the medium term. So plenty of room for interpretation there, not a great deal of detail. But Macquarie's saying it's maintaining its cautious stance. It's looking at high inflation, higher interest rates. Again, nothing that we didn't really already know. Conspicuous by its absence, though, any mention of AirTrunk. This is one of Macquarie's businesses that a number of industry watchers have been thinking, well, maybe they might sell in the coming 12 months. Macquarie has an 88% stake in that business that it bought for $3 billion. Last Bloomberg estimate had AirTrunk valued at close to US $8 billion. So if we did see a sale of that business in the coming 12 months, well, that'd be a big sugar hit for the bottom line. And perhaps that's why we're seeing a little bit of seesawing in the share price this morning.
As Paul Allen in Sydney there, and let's get more corporate stories that we're tracking this morning. And Sony and Apollo are said to have made a $26 billion bid for media giant Paramount Global. Sources say the offer is a non-binding expression of interest and would be an all-cash offer for Paramount shares, plus the assumption of debt. Paramount's also been weighing a merger proposal from David Ellison, the head of Skydance Media. Bloomberg's learned that Nomura and Mizuho Financial Group are facing more than $100 million of potential losses tied to failed stock trades by All Blue Capital. Sources say All Blue made a series of wrong-way short bets earlier this year and was allegedly unable to settle the trades. The size of the losses raises questions about risk management of two of Japan's largest banks. Hong Kong's securities watchdog has launched criminal proceeding against hedge fund Saganti Capital Management, its founder Simon Sadler and a former trader. In one of the most high-profile financial prosecutions in the city, the SFC alleges insider dealing in shares of a listed company before a 2017 block trade. The case will return to court on June 12. Adani Enterprises says it's received questions from India's markets regulator over possible violations. According to an exchange filing, the firm got two short cause notices over allegations of rules of non-compliance. Other Adani units also received notices. Adani Enterprises posted a 38% slump in profit last quarter, hit by one-time charges at its airport unit.
And, Belle, we want to keep an eye on shares of MGM China when trading in Hong Kong gets underway in just about 30 minutes' time. The parent company, MGM Resorts International, paired gains in New York after first quarter sales and earnings beat estimates. Their CEO, Bill Hornbuckle, told us their aggressive approach to China is paying off.
When you think about a couple of our markets, we question, we challenge, is there going to be real growth there? What are the capital requirements coming up? And how are we best and our shareholders best served? And in a couple instances, we probably will do something, but that's time to tell.
You know, when you look at the excess cash that you reported, I believe it's about $1.2 billion, Bill, and it raises the question, would you consider acquisitions at this point, particularly when it comes to expanding in your digital presence, online sports betting?
When you think brick and mortar, I think less so. We are more interested in new jurisdictions that have real growth. We're building in Japan, and that'll take a great deal of our cash over the next couple of years. But when you think about digital, we see that as the horizon. And I know we have a partnership with Entain and BetMGM here domestically, but we've invested a great deal of time, energy, and money, and we'll continue to do so internationally through our Leo Vegas acquisition. We now have a content gaming company that helps us provide content into that business. We're looking for other bolt-ons that would make it make sense. We're very interested in live dealer, a proposition we'd like to motivate here from Las Vegas and broadcast to the rest of the world. We think it could be meaningful over time. And so we're going to continue to invest into that space and relatively aggressively, but realizing those are not massive capital allocations or capital outlays. They're more structurally getting a business right for long-term growth.
And Bill, we don't have much time left, but we haven't even talked about China, and we have to talk about what's going on in Macau, where you recently gained share. I think a lot of people got excited to see those details in the report this morning. What do you attribute that gain to? Is that just the overall pie growing? Of course, that recovery is still going on. Are you actively taking share in that market?
No, I think we're actively taking share. Look, we came into the pandemic with about 8 or 9% of the market. We currently sit in the mid-teens. This last quarter was 17%. We've been aggressive in the context of what we've done to the properties, what we've done to the casino floor and the layout, how we've approached a new era without junket operatives. We've had offices all over the globe, most notably in the Far East, for 30 years. And so our ability to leverage into our own network and our own systems to go get customers directly and understand their wants, needs, and desires, we think is somewhat unique, and it's paying off. And you can see the results. Obviously, we just hit our quarter over $300 million in cash flow, which was an all-time record, and we believe we can sustain this level.
That was MGM Resorts International CEO and President Bill Hornbuckle speaking exclusively with Bloomberg's Shonali Bassick and Katie Greifeld. And be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team broadcasting live from our studio in Hong Kong. You can listen via the app Radio Plus or on BloombergRadio.com. Plenty more ahead. Stay with us.
Take a look at how we're faring just about an hour into the start of trading. And of course, it is a little bit of a holiday quieten session with Japanese stocks not trading today. We did see a little bit of a softer finish to the Thursday session there. The Kospi is up by just about 0.5%. They're being lifted by a lot of the tech names, seeing a good reaction across suppliers when it comes to what was ultimately a mixed bag for Apple earnings, but certainly some of the optimism when it comes to the Chinese market and the growth kind of trajectory going forward came as a sigh of relief for many investors that have gotten used to quite a bit of downside headlines and sentiment for Apple across its most key markets. Here in Australia, we're seeing the ASX 200 up by about 0.5% there as well. Some of the consumer names, again, some of the tech shares are helping build that climb as well. Consumer discretionary, one of the outperformers, really following on the back of US stocks being higher on the back of the corporate earnings optimism there as well. We're seeing Kiwi stocks little changed at the moment after trading a little bit softer. Dollar yen holding pretty steady at 153.10 amidst more evidence building that we did see a second round of intervention this week, Belle.
Yeah, that's right. It's certainly something we'll be tracking very closely when we get that official data out. But as you said, that focus coming down to Apple in the session and those better than expected numbers, perhaps mixed report, yes, in some senses, some sectors performing better than others, services, for instance, versus wearables weakness, iPhone sales as well, a big watch, but certainly be tracking the supplies when the Hong Kong session opens in just over half an hour's time from now. But there's some of the ones in focus for us. Mainland China is shut for another session today. But of course, the focus on Hong Kong and that sort of outperformance we've seen over the course of this week, that well-beating stock rally certainly showing no signs of letting up at this point in time. But just taking a look at this RSI here, because you're topping 70, the question is whether we see this sort of contraction starting to come into the session. But that's it from Daybreak Asia. Our markets coverage continues.